Welcome to Econoday Unplugged. It is Wednesday, April 25th, 2018. With me today are Jeremy Hawkins in London and Mark Pender in the U.S. I am Ann Picker, Econoday's chief economist. The first month of the second quarter is almost over, believe it or not, and the end of this week is marked by first estimates of first quarter GDP growth. France, the UK, and U.S. all on Friday. The cycle of GDP releases stretches into the first week of June for Canada and Australia. We are also entering a new cycle of central bank announcements. This week, the ECB and BOJ, followed next week by the Reserve Bank of Australia and the Fed. Jeremy, the ECB announces imminently, tomorrow.
It does.
Given the slowdown in monthly data, it will be interesting to hear what Draghi has to say.
Indeed, it will. As folks probably remember, the last meeting on March the 8th, we saw the council decide to switch from an easing to a neutral bias on what was then the basis of building momentum in the Eurozone economy. But really, there was nothing else of note then, and indeed most council members were still clearly worried about low inflation. Now, since March, almost without exception, the economic news has been disappointing, and growth forecasts for the first quarter, if anything, now have been shaded lower. Now, as you mentioned, we'll get the French flash GDP figure, which will give us some clue about the Eurozone on Friday. We'll also get the Spanish preliminary data on Monday, and then the preliminary flash Eurozone GDP figures themselves next Wednesday. I guess at the moment, the forecasts, we don't really have too many of them, but they're probably coming in round about the 0.4, perhaps 0.5%, which would be a quarter-on-quarter rate, which would certainly constitute a slowdown. Now, although we have had a rebound in inflation in March, that was up to 1.3% from 1.1%, it's clearly still low, and indeed probably biased up by the early Easter anyway. And the narrowest core rate was just flat at 1%. So if you put it all together, slowing economic growth, underlying inflation still going nowhere, it's difficult really to expect anything new out of Thursday's meeting. And so as you mentioned, it's probably really down to what Mr. Draghi says. And if anything, as per usual, Draghi tends to be pretty cautious. So I think in terms of euro risk, the potential is that he could say something which highlights the slowdown in growth we've seen in recent weeks, and that could certainly undermine the euro a little bit. Aside from that, I've got to mention, unfortunately, for the UK side of things, the latest on Brexit. I guess Brexit has been a little bit on the back burner for the last few weeks, but that's not the case now. So last Wednesday, we had the House of Lords, the second chamber over here, defeating the government, coming out in favour of staying in a UK-EU customs union. Of course, the UK government policy is firmly against such a move. This now goes to a debate in the House of Commons tomorrow, Thursday. And although the result will be non-binding, it's certainly going to ratchet up the pressure on the Prime Minister if we see enough Tory defectors vote with the opposition parties in favour of remaining in this customs union. Now, the government still insists that it's no to a customs union after Brexit, but these in-party splits are so wide that ultimately it could even turn into some sort of vote of no confidence. And of course, if Mrs May were to lose that, at the end of the day, the government could fall. Now, there has been some talk that Mrs May could back down on a customs union on the grounds that, well, it only covers goods, and as far as the UK is concerned, it's the services side of the economy which matters that much more. But of course, if it were to undertake such a U-turn, it would risk a severe backlash from the pro-Brexit camp. So really, she's damned if she does, and she's damned if she doesn't. And all we can say at the moment, if nothing else, politics is certainly going to keep the pound amongst the most volatile of the major currencies over the foreseeable future.
Thank you, Jeremy. The Bank of Japan also announces this week, Friday, Japan time, it will be the first time that the two new deputy governors of the bank will participate in the decision-making process. The BOJ is expected to maintain the view that inflation will reach 2% target next fiscal year, which would be 2019, and project that it will stay near that level the following year. The central bank is not expected to change policy this week, but the debut of a dovish new deputy could widen the rift between advocates of continued stimulus and those wary of the rising costs of prolonged easing. Governor Kuroda is expected to reassure markets it is nowhere near an exit from its ultra-loose policy, given the risks to the inflation outlook. Mark, first quarter GDP on Friday. It's always a difficult quarter to try to estimate, given uncertainties weather-wise and the like, that can impact growth. And long-standing issues with the seasonal adjustment process also compound the problem. And then, of course, there is the FOMC next week.
Right. Well, the GDP consensus is pretty moderate. Canada's consensus is 2%. The range goes from 1.3 to 2.8. All this would be just below the prior quarter's 2.9. What's interesting about the first quarter is the consumer side. Despite a very big tax package and despite continuing strength in consumer confidence readings, which we just got the latest yesterday, Tuesday, very, very strong. Income expectations near records, at records. Yet it hasn't, and it never really did translate to much consumer spending in the first quarter. We don't have all the numbers in yet. There was a peak in auto sales in March, which have been slow going out of the hurricane replacement time in September, and it really pulled forward sales. And all of a sudden now auto sales, which are a very important barometer, have popped up. And that consumer confidence report, one of the readings inside that report was an unusual pop in plans for consumers to buy autos. So there is the possibility, I think, that we could be a little bit of an upside surprise on the consumption expenditures, but the Canada's consensus for that is only 1.1%. That's an annualized rate, and that would be a quarter of what the fourth quarter's rate was, and at about half of what the rates were in the prior quarters. So I think that will be the interesting piece for GDP. It looks to be cooling, and it's like you said, there's a lot of other issues with the first quarter, and it could be easily considered an outlier. Certainly, there is no expectations of it influencing the coming FOMC meeting with a rate hike then expected for the June meeting. But what we are seeing, a very important note in the markets right now, is an emphasis on the bond market, where demand is easing just a little bit. We're getting to 3% on the 10-year Treasury yield, which we haven't seen for 4 years. Yet it's just a psychological number, and rates have only been inching up a little bit. And there's probably plenty of factors behind it. And I think certainly one of the factors is stress we're seeing in the supply chain, not being able to really keep up the pace with demand right now. So we're getting extended delivery times, we're getting unusual increases in raw materials, and a little bit of an indication perhaps we're going to start getting on stockpiling of raw materials. And this is going to be in reference to the tariffs that were imposed on steel and aluminum in March. And that has had an upsetting effect for manufacturers and also in the construction industry. And there might be a little bit of an indication of capacity stress now in construction, not being able to get the projects underway, get them finished because of lack of or hard to get materials and equipment related to those tariffs. But these are initial fuzzy little signs that we're maybe getting. But I think the risk, as stressed in the bond yield, is for a capacity stress, not having enough available workers, enough available materials to meet demand.
Mark, can I ask you a question about this backup in bonds? In terms of its economic implications, you mentioned this sort of 3% mark being some kind of psychological level, which at the end of the day, I suppose, may or may not be important. But is there a concern that if we do continue to see bond yields rise, then clearly that's going to add to the cost of government borrowing on top of the kind of a tax package that we see Mr. Trump and co put through? So in terms of the implications for US borrowing and debt, it's not going to look too clever.
No, and the expectation, of course, is that rates will continue to rise, and there's a couple of other factors involved here. We can't forget what's going on with the housing sector and what these mortgage rates, higher mortgage rates, and they are climbing, and what this means for housing. We had a bunch of housing data earlier this week, and on the whole, it was very strong. And getting back to Ann's point about first quarter volatility often tied to seasonal adjustments. I think we did see that with the housing market. We got a big pickup. Now, will that continue? And then you add on to this, the Fed's unwinding its balance sheet. So there's one less very important buyer in the bond market at the same time that the government is increasing its demand for treasuries. So there you go. I mean, it's almost, we having warning signs, at least volatility signs in the stock market. And then there's some real, I think, fundamental cracks that you have to look at in the treasury market. But whether or not it will pan out, the treasury market is a very important market with lots of global demand. And another risk is, and I'm just saying these as risks, is that China owns the most treasuries of anyone, and 1.1 or 1.2 trillion, whatever the latest number is, and they could use that, of course, as begin to liquidate that in a tariff war as an important weapon in a tariff war. And that would further raise U.S. interest rates. So but all these probably are going to be pluses for the dollar, because the dollar now is not depreciating like it was. It was through last year, it depreciated about 10%. And then through the first quarter, it was depreciating at the same rate of 3% and for the quarter. So, and now that is starting to reverse a little bit, which would throw another factor into the mix.
Thank you, Mark. Thank you, Jeremy. Until next week.